Good evening, value investors, friends, family from YouTube. Today we're going to be looking at an article that was published relatively recently by some folks at Yale University and the University of Rochester from their economics departments that I believe have huge import on our lives now and into the future if we do in fact believe in the fundamentals that have been laid before us by Graham, Dodd, and the whole those whole principles. I found this research particularly interesting because it does in fact reflect on whether or not there are principles that could be relied on or factors to help us determine price in the short term and in the long term. So with that, I'd like to proceed with the reading. Let me just make sure we're getting audio. In the short term. Excellent. Okay, so we're looking excellent here. This is the article that I'm referencing for this evening. It's entitled Risk and Returns of Cryptocurrency by Liu and Savinski. And the abstract is as follows. We established that cryptocurrency returns are driven and can be predicted by factors that are specific to cryptocurrency markets. Cryptocurrency returns are exposed to cryptocurrency network factors, but not cryptocurrency production factors, which is incredibly fascinating. Because typically, with the vertically integrated company of the 1900s, this wasn't the case. As a matter of fact, price was intimately related with production. Excuse me. We construct the network factors to capture the user adoption of cryptocurrencies and the production factors to proxy for the cost of cryptocurrency production. Now here's the kicker. Moreover, there is a strong time series momentum effect, and proxies for investor attention strongly forecast future cryptocurrency returns. Now this is a huge deviation from traditional literature in the sense that while it seems intuitive, I don't think people, especially people who follow Graham Dodd value investing, like to think that the value or the price of a security, and in this case the security that we're looking at is cryptocurrency. I don't think people like to would even like to entertain the idea that the price or the value of any one thing is derived from the attention that it gets. But this isn't such an uncommon phenomenon. We see with platform companies like Apple, Amazon, they do this all the time. You know, they are the main transactor. They own no assets that are productive. They simply outsource that job. And what these companies do is they facilitate transactions. So if we look at someone like Apple, for example, Apple, and this is referenced in several pieces of literature that I guess I'll link them in the comment section after I upload this live stream. They provide the architecture for developers to develop applications. They put that on their ecosystem, so to speak, and then demand from the consumer, right, comes. So they hop on board on the Apple technology. They get the Apple iPhone or the Apple Mac, and then they download that application that was not created by Apple. It was created by a developer, and then the profits from that person demanding that application that was created by the developer, those profits are split typically half between Apple and the other half provided to the developer. So in that whole transaction, Apple simply serves as the middleman between the producer and the consumer. In the same sense, cryptocurrency serves a similar, it does a similar job, right? Except that as opposed to a centralized service, it is now a distributed network of computers or nodes that are securing and establishing the veracity of any one transaction on a ledger that promotes privacy. So this is where the value is derived from for cryptocurrency, not so much production factors as is noted by Liu and Tsyvinski. Now I've read the abstract. I want to make this somewhat of a reading, somewhat of a review, and somewhat of a commentary. I actually have my copy here of the document with notes and highlights. I'm going to have this paper up, and I'm going to try to match it to the page that I'm reading from and making commentary on. So forgive me if I'm not necessarily one-to-one with the commentary that I make. Because I'm a kinesthetic learner, so I had to print this whole document out. It's beefy, and I wanted to mark it up. So with that being said, we will push forward. Now, if you're familiar with cryptocurrency, and specifically if you're familiar with the research behind cryptocurrency, then some of this stuff might not be so new. This document was published, if I remember correctly, in September of 2020, so this is a relatively new piece of literature. But I found this fascinating enough to share with you guys. In fact, I found it critical to share with you guys since I simply want to add value to our community. And keep in mind, and if you've been following me for some time, then you know this about me. I subscribe to a value investing framework, and I've been pushed, happily, I've been pushed by the viewers, by you guys, to try to think a bit differently and try to develop some nuances when it comes to value investing. I know recently Nubank was invested in by Warren Buffett, and a lot of people are joking and saying that Warren Buffett finally came out of the 1960s and he invested in a cryptocurrency company, which is excellent. But now I think the challenge becomes, how can we value, like any one security, how can we value the fundamentals of a cryptocurrency, right? Do we need some very deep knowledge of cryptocurrency development protocols? Like, for example, Cardano, do we need to know Haskell? Or if we're working on Ethereum, do we need to understand how ERC tokens are minted and developed? These are questions that are troublesome for me, because if that is the case, then that is a huge barrier to understanding and investing in cryptocurrencies in a sensible way. If we go on Reddit, or if we go on platforms where you can see, Twitter, for example, where you can see the sentiment of investors. Most recently, we're going through a pretty strong dip, right? And there's been some positive news. I read on Reddit that, and this is not just on Reddit. I mean, this is world news. El Salvador has made Bitcoin legal tender, which is excellent. And I think it's about time. And other countries like Panama, timely that this document is introduced to, at least to my very small community, and maybe we can bring about some sensibility to and some understanding to these price movements and fluctuations in the cryptocurrency market, which, if I remember correctly, let's take a look at what's it at now. Let's see, CoinMarketCap.com. Let's see what the cryptocurrency market is valued at. $1.6 trillion, right? Which is down from a high of 2.4, if I remember correctly, $2.4 trillion at the end of the semester. Last semester, I remember always opening up my statistics courses. I taught a statistics class, and I would open up the course with a recap of world events, and I would always include CoinMarketCap and the market capitalization of the cryptocurrencies in existence. And I remember back then, towards the end, it was at 2.4 trillion. Good memories. Missed those guys. So let's dive into this article here. Now, the first thing that I've highlighted on this article is found on the first page, and it's here in the middle, where it says, the first group of papers builds models stressing the network effect of cryptocurrency adoption and emphasizes the price dynamics induced by the positive externality of the network effect. Right. Let's go back to the first sentence and just introduce the topic. Cryptocurrency is a recent phenomenon that is receiving significant attention. On the one hand, it's based on a fundamentally new technology, the potential of which is not fully understood. However, on the other hand, at least in the current form, it fulfills similar functions as other more traditional assets. So, if we take a look at this sentence here that I highlighted, where they talk about the positive externality and network effects, what they mean by that is that the cryptocurrencies derive value from the users that engage it. You could have the best, most incredibly functioning cryptocurrency in your space, but if people are not participating and agreeing to use it and transact with it, then it really has no value. If we look back, and you might be familiar with this book. Let's see if I can find it. This book here. Made a big mess. Modern Monopolies. So this book here talks about how Tinder was brought about, and she had the woman who developed Tinder had an incredible focus on making sure that the primary transaction, right, the thing that we now know so famously, the swipe right and swipe left, she made sure that the focus of the user interface and everything was super on point. But she had the job of bringing people on board. And with Tinder, right, there are males and there are females, and they have to be matched appropriately. So what she did, and I might be butchering the story, so forgive me and read the book. But basically, she went to sororities. She hit the boots. She hit the ground running, right? Boots on the ground approach. She went to sororities and she said, "Hey, I have this excellent application, and I heard that Alpha, Beta, Gamma guys are on there." And they weren't really on there, but she was telling the sorority folks this because she wanted those girls to get on her application. Because if the girls weren't on there, then it wouldn't work, right? But the boys are needed too, so she went over to the Alpha, Beta, Gamma guys, and she said, "Hey, Alpha Tau girls are on there. What are you guys waiting for?" And they weren't really on there yet. But what happened was she did such a good, quick, efficient job of marketing her application. She reached a critical mass, and people started transacting on her application, now known, and even then known as Tinder. So that's what made it work, and that's what increased the value of Tinder. Tinder is an excellent application, and it's excellent from an analytical sense because the user interface and everything. There's a whole science behind making sure that your application is made efficient for transacting and serving as a middleman between a producer and a consumer. In Tinder's case, it's a bit more specific to dating and matching. But let's go back to the risks and returns of cryptocurrency. This is what they mean when they talk about network effects. They're mentioning the fact that the utility from cryptocurrency is derived from the people who are adopting it. If we go to the second page, and scroll down here. So the authors of this document go on to say that there is also a growing literature on the empirical regularities of cryptocurrency. Bori 2019 shows that individual cryptocurrencies are exposed to crypto market tail risks. And all that means is that there's some activity, right? What you would consider improbable activity, there is some activity nonetheless that occurs at a higher clip than what you would expect with a normal curve. We'll elaborate more on that in a moment. They go on to say that further down, the next paragraph, we start by constructing an index of cryptocurrency or coin market returns. This index is the value-weighted returns of all the coins with capitalizations of more than 1 million in United States dollars. Excuse me. And covers the period from January 1st, 2011 to December 31st of 2018. We now describe some basic statistical properties of this index. Now here's what I find fascinating. During the sample period, the averages of coin market returns at the daily, weekly, and monthly frequencies are 0.46%, 3.44%, and 20.44% respectively. The daily, weekly, and monthly standard deviations of the coin market returns are 5.46%, 16.5%, and 70.8% respectively. So just taking a look at that, right, you have your mean on the daily. So in any one day from this data, you could have an average return of 0.46% of any money that you've invested in the cryptocurrency market. However, the standard deviation of this is such that you could actually have a negative return to the tune of about negative 4.5%, all the way to as high as 6% return, right? So there's that, it's set right at the middle at 0.46%, and then you have negative 4.5% here, and then 6% on the right side. The same thing holds true with the weekly and monthly figures, 16.5% and 70% respectively. And that's huge volatility. That is incredibly huge volatility, but there's also incredibly huge returns. I mean, if you look at the standard yearly return of investing in the stock market, figures go anywhere from 6% all the way to 11% on the basis of what time period you choose. And you take a look at the fact that in 1 week, you'll have a return of 3.44% from 10 years of data. That is incredibly huge. That is massive. And if we just look at the month, you'll get a 20% return. Warren Buffett averaged 20% yearly returns since the 1960s, and he's considered the best investor, one of the best investors, if not the best investor of all time. And the fact of the matter is that the cryptocurrency market has returned 20.44% month over month. from this data. That is incredible, right? You might be wondering, well, what is the yearly return? Well, I actually calculated the CAGR. Let me pull it up here. Let's go to desktop and let's go to this. Forgive the screenshots. I'm trying to select a good screenshot for this live stream. If we look at the CAGR of the coin market capitalization, right, from 2013 to 2021, we're looking at, let me erase this, we're looking at 139% year-over-year growth on average. That is incredibly fast. If we compare that to the United States stock capitalization, right, so this is the sum total of all the corporation market worths combined, right, so from 2013, 2014 onward, it simply achieves a 9% year-over-year growth. You compare 9% year-over-year growth to 139%, you could imagine how fast a dollar would have grown if you would have kept it in the cryptocurrency market versus the United States stock market, right, or equities market. Now, I did a simple calculation of percent of stock market to see the transfer of wealth, right? Because, I mean, let's be real here. The only people who have investments in the United States stock market or the cryptocurrency market are people who can afford it and have a bit of excess to invest in. So, you know, I'm curious to see what these people are doing with their money so that I can personally understand, and I'm sure you're thinking the same, so I can personally understand where exactly are we when it comes to cryptocurrency penetration. And if you go back to 2013, right, keep in mind Bitcoin was founded in 2008, but we don't have, at least I don't have data going back that far. Neither do the researchers. They have it as far back as 2010. But nonetheless, the example that I'm about to show still makes sense. 0.01% of the stock market, right? So the coin market capitalization, the cryptocurrency market capitalization, or the sum total of the market worths, the cryptocurrency worths, was at, what is this, 100,000 million, 1.3 billion. That represents 0.01% of the United States stock market. But we go to 2021, most recent figure, this was correct as of last night, we're now at 3%. And that growth is massive. Let's just push this over. Look at this. The growth, the CAGR, year over year, is going at the same rate, slightly slower, but still, this is like light speed. It's growing about the same rate as the cryptocurrency market. So, just looking at this, it's almost like, what are you doing keeping your money in the bank, right? I mean, that's what it says to me. What are you doing keeping your money in the bank? You could have had your money grow at this clip right here. So there's something going on here, and we need to understand it. Let's go back to our article. So what these guys do is they take they literally go to coinmarketcap.com, and they take data from 2013 all the way through 2018, and then they come to certain conclusions. Let's see. Skip past this. Here it is. Let's go to page 2691. Okay. And I'm going to start from here. The existing theoretical models of cryptocurrencies have a number of implications for the predictability of cryptocurrency returns. Some papers argue that the evolution of cryptocurrency prices should follow a martingale. Now, what is a martingale? Well, it's just random stochastic process, but I'll show you anyways, martingale, because it made sense to me when I saw it. That's a martingale. Sequence of random variables for which at a particular time the expectation of the next value is equal to that of the present value. So it's basically random, or it has a 50% chance of going up or down. Where were we? So basically, these guys are saying that you'd expect cryptocurrency prices to be random, right? Simplification, I know, but still. And thus, cryptocurrency returns are not predictable. This is according to Schilling and Ulig from 2019. Other papers argue, however, In dynamic cryptocurrency valuation models, cryptocurrency returns could potentially be predicted by momentum, investor attention, and cryptocurrency valuation ratios. Credit to Kong, Lee, and Wang, 2019, as well as Sokin and Zhang, 2019. We show that momentum and investor attention strongly predict future cryptocurrency cumulative returns, but cryptocurrency valuation ratios do not, to my dismay. Oh, it was very painful to see that. So valuation ratios in the sense of fundamental analysis type stuff, metrics from the value investing framework. So we're going to get to this at a later time in the paper, but you'd like to think that. So, for example, let me say it like this: a fundamental analysis of a cryptocurrency could be something like user adoptions divided by market capitalization. And the research shows, while not significant, I'm spoiling things here, while not significant, user adoptions measured in wallets divided by total market capitalization of whatever cryptocurrency you're looking at, or the entire cryptocurrency market, is it's correlated to returns in the future, but not significantly. So I would have liked it to be that easy, right? And they'll talk about that as well, but it's not. It's not. And as a matter of fact, it looks like cryptocurrency doesn't really act like any other asset class that we've seen before. Doesn't act like let me just push forward. First, we show that there's a significant time series momentum phenomenon in the cryptocurrency market. And time series momentum is basically, if you look at the past 12 months, simplification, I know, but bear with me. You look at the past 12 months, if the returns are positive, then time series momentum indicates, this is well researched, that the future time horizon, whatever time horizon you choose, preferably a little bit shorter than longer, than more out into the future. The future is going to be positive, right? So if past 12 months are positive, then the next month, let's say, will be positive too. So we find that the current coin market returns predict cumulative future coin market returns from 1 week to 8 weeks ahead. So this is where your money's worth is, guys. If you've been listening this far, this has huge implication on, or at least it should have huge implication on your investing strategy, because they have found evidence that suggests that time series momentum is correlated with cryptocurrency return. So if you want to make money in the cryptocurrency market, then you should really study this phenomenon, right? I mean, I'm no financial advisor. I'm not telling you what to do with your money, but this certainly has import, at least in my life. So they go on to say, for example, a 1 standard deviation increase in the current coin market returns predicts a 3.3% increase in the weekly returns over the next week. Grouping weekly returns by terciles, we find that the top tercile outperformed the bottom tercile, right? So 3 partitions. Top tercile outperforms the bottom tercile over the 1 to 4 week time period horizon, right? So again, incredibly fascinating. Going down to the very bottom, right? Second, we construct proxies for investor attention with Google searches and show that high investor attention predicts high future returns over the 1 to 6 week horizons. For example, a 1 standard deviation increase in the investor attention measured in the investor attention measure yields a 3% increase in the 1 week ahead future coin market returns. Again, incredibly important. So the more attention a coin gets, the higher the return is going to be. We'll talk more about what this means and how we can take advantage of it. Let's see. Another proxy for investor attention we construct is Twitter post counts, and we reach similar results with the Twitter measure. Again, incredibly fascinating. Let's scooch down here. A couple other things here. Here's some things that I'm reading off. I've highlighted important pieces to kind of get to the meat and potatoes of it all. 2692, so page 2692 is where I'm at now. In the second paragraph on the page, we find that investor attention is high during and after periods of high coin market returns. However, in a bivariate coin market predictability regression with both variables, we show that the two effects do not subsume each other. And the two effects that they're referring to are the time series momentum and investor attention. So in the stock market, there are interaction effects. such that they correlate with one another. But in cryptocurrencies, time series momentum appears to be independent of investor attention. So for example, if there's high investor attention, let's say positive investor attention, then that contributes positively to cryptocurrency returns. You don't need time series momentum. In other words, you don't need the past 12 months to be positive in order for positive attention to do its job. Hopefully that makes sense. Scooching down to the third paragraph, it is more difficult to define a similar measure of the fundamental value for cryptocurrency. So whereas you can look at the book value of equity to the market value of equity for a stock, fundamentals, we were talking about this a moment ago, fundamentals for cryptocurrency, it's a little bit more difficult. So in their dynamic cryptocurrency asset pricing model, Kong, Lee, and Wang from 2019 showed that the cryptocurrency fundamental to value ratio, defined as the number of user adoptions over cryptocurrency market capitalization, negatively predicts future cryptocurrency returns. Now, that's a mouthful, so let me break this down. Okay, let me see if I have, let me go to MS Paint here. MS Paint. It's better if I just draw this out. Online, free online. Is this it? Nice. Okay, so I had to draw this out, and this will help. There's an arrow. Turns. Oops. And then we'll do this. And I'll explain this in a moment. I mean, maybe you're smart enough to just already understand what that meant. I'm not that smart. I get to try it out. But for the folks who find this useful, then I'm happy. Okay. So what this means is that so it is more difficult to define a measure of the fundamental value for cryptocurrencies. In their dynamic cryptocurrency asset pricing model, Kong, Lee, and Wang show that cryptocurrency fundamental to value ratio, defined as the number of user adoptions over market capitalization, negatively predicts future cryptocurrency returns, right? So we're interested in when cryptocurrency returns are high or when they go up, right? So as cryptocurrency returns go up, right, this is correlated or associated with this ratio here, where users divided by market capitalization. So you would need users to go down in order for this case here, in order for this case to occur. High returns, you need users to go down, and you need market capitalization to go up. So this makes intuitive sense, right? Because if you think about it, the early cryptocurrency market was exactly this. You had low users, but you had a crap load of money coming in from angel investors, from regular investors, from whales, from all different types of folks. So there was this influx of money and a little bit of users. So there was a hell of a lot of profits still left. I'm thinking to economics. There's a lot of profits left to be had, right? So then that entails a future filled with high returns. That's exactly what we're trying to predict here, right? We want to know what coin specifically at this point. What coin is going to give us high returns? Well, the research shows that maybe it's not so significant, but nonetheless, there's still something here to be had. Research shows that as users, if a coin has low users but a high market capitalization, or maybe not in the scientific sense, but a significant market capitalization, right? Not like I don't know, $50,000 market cap, something higher than that. Then it goes without saying that perhaps in this current growth state, the market, the cryptocurrency market I know is in a growth state, you will experience high returns. This is what the research is suggesting. Okay, back to the research. Although the coefficient estimates are consistently negative, right? So in other words, it's saying that while the behavior, the phenomena of what we just went through is there, it is None of these 6 cryptocurrency valuation ratios predict future cumulative coin market returns significantly. So that's the only sad piece. So the coefficient is there, the relationship is there. If you were to look at a graph, you would see a dot plot, and you would see the relationship is there, but it's not a significant one. So that's okay. Let's push forward and flesh out some more of this article. Another approach to study what cryptocurrencies represent is to examine the exposures of cryptocurrency returns to other asset classes. In other words, we assess how investors and market value current and future prospects of cryptocurrencies. So the theoretical literature and the community of cryptocurrency have proposed various narratives for what cryptocurrencies represent. So I'm at the bottom of page 2692. Here we go, right here. So Schilling and Uhlig from 2019 argue that in an endowment economy, the United States is an endowment economy, where fiat money and cryptocurrency coexist and compete, the cryptocurrency returns co-move with the price evolution of the fiat money. Aleh et al. From 2016 emphasized the importance of currency exchange rates on cryptocurrency prices. Now, another popular narrative is that cryptocurrency is digital gold. I know you guys have heard this before. And represents a new way to store value. Specifically, we study whether the major cryptocurrencies co-move with currencies, commodities, stocks, and macroeconomic factors. Excuse me. In contrast to these popular explanations, we find that the exposures of cryptocurrencies to these traditional assets are low. Overall, there is little evidence in the view of the markets behind the narrative that there are similarities between cryptocurrencies and these traditional assets. Again, huge implication, guys. So, human beings, we try to understand cryptocurrency from the perspective of comparison and analogy. So, people say, oh, well, Bitcoin is digital gold, right? It's a store of value. Research suggests no. There's no evidence to suggest that that is correct. Cryptocurrency is like fiat money. Again, not really. It doesn't really behave like fiat currency. And in fact, doesn't behave like anything we've ever seen. It behaves like a brand new asset class, which is fine. It's fine. It's something brand new. And I think that it's going to take a very long time for people to understand that we are dealing with something brand new here. And I think a lot of that comes from cryptocurrency's flexibility. We could never write on a dollar bill, a contract. You know what I mean? But with cryptocurrency, you can write a contract. Like, say, for example, the typical example is a property deed, right? So with cryptocurrency, you can not only transact the value for a property that you're buying, but within that transaction, in the metadata, you'll see that it is written, assuming you execute the contract appropriately, you and your interlocutor, it is written such that the deed is now owned by X person who purchased it for X dollars. And that's an executable contract once all the requirements are fulfilled. So it's like a brand new, what I'm trying to say is that cryptocurrency is a brand new asset class because of how flexible it is. At least this is just my little anecdotal understanding. Let's push forward. I want to, in this area here, third, we investigate the importance of regulative events in affecting cryptocurrency prices and show that negative regulative events, but not positive regulative events, significantly affect cryptocurrency prices. This is actually a really important paragraph. We note several additional results. First, we acknowledge that we have a short time series and that there is much uncertainty in learning about cryptocurrencies during the sample period. We show that our main results are similar for the first half and the second half of the sample. They had to do this because their sample spans such a large amount of time, large with respect to the speed of technological development, so they had to make sure that they were dealing with the same thing towards the end of their data, in terms of time, as compared to the beginning, like in 2013. Second, we discussed the relationship between cryptocurrency time series momentum and cross-sectional momentum. Third, we investigate the importance of regulative events, and we already discussed that, where they respond to negative but not positive news. Fourth, we examine the importance of speculative interests in driving cryptocurrency prices. We show that cryptocurrency returns are higher when speculative interests increase, but the coefficient estimates are only marginally significant. Fifth, we construct a direct measure of cryptocurrency investor sentiment and show that the expected coin market return is higher when investor sentiment is high. In the multivariate regressions with the sentiment, investor attention, and momentum measures, all three variables are statistically significant in predicting future cryptocurrency returns. Sixth, and I'm just going through this paragraph because it really is the crux of this article. Sixth, we test the role of beauty contests in cryptocurrency market, and beauty contests, it's not like the traditional what you think, it's something financial. Motivated by Bayes and Boesert's 1998, we use the volume volatility ratio to capture the degree of disagreement in the cryptocurrency market and show that cryptocurrency return is high when the current volume volatility ratio is high. But if I remember correctly, that's not a significant result. Seventh, we conduct a VAR analysis with the coin market returns and the different measures of coin network growth measures. Eighth, we test the effect of production factors with an alternative specification. And lastly, we examine the subsample results based on cryptocurrency characteristics. So that is where this paper is going from start to finish. I read this entire document, and those statements have some holes that I think are very important. And we'll go over them for sure. But again, this whole, if you're just tuning in or if you fast forwarded through and I've already uploaded this and you're wondering what the hell this is all about, this is an article that basically talks about what factors contribute to predicting cryptocurrency price, right? So if we could predict cryptocurrency prices to some degree of accuracy, then we know exactly where to park our money, right? Coin by coin, we would be able to increase our value using whatever factors are related in this article. And they have some very interesting results that I'm currently sharing, namely time series momentum, incredibly important in determining future returns, and investor attention, right? So if you look at tweets, and you look at Twitter, and the tweets are generally positive, you're going to see a high return, a positive return, I should say, for any one cryptocurrency coin. But let's push forward. Okay. Here's the interesting piece here down at the bottom. So going back to, and you guys know if you followed me for some time, I subscribe to a value investing framework in the sense that I like to know what the intrinsic value is of whatever equity or, in this case, cryptocurrency I'm investing in. And this current piece here is elaborating on certain fundamental metrics that we could try to grab onto to make some sense of these cryptocurrencies, right? And this isn't going too deep, because in reality, a fundamental analysis would involve a full breakdown of the protocol and the scripts that are used to execute the actual the stewarding of the ledger, and a couple other factors. But I mean, nonetheless, this is incredibly fascinating, and some of the first literature that I've seen that actually puts some pretty easy numbers, right? Some numbers that you could work with here off the cuff, so to speak. So we use 4 primary measures to proxy for the network effect of user adoption: the number of wallet users, the number of active addresses, the number of transaction count, and the number of payment account. The data of the wallet users are from blockchain.info. Let's push forward. We'll just go on to talk about how they got their data. And here are some charts where it shows the actual returns on a daily, weekly, and monthly basis. Coin market return distribution. So this figure plots the distributions of daily, weekly, and monthly cryptocurrency returns and log returns, right? So in a nice and neat fashion, they have the mean standardized at 0, and then they have the standard deviations of -2 and +2 on the left and right, respectively. And look at the concentration, right? I mean, this is fascinating enough if you just look at the distribution of the data here, right? you'll see that there's a very high concentration around 0, slightly right skewed, which is good for us. And I think this is more of an indication of the fact that if we go back to the product diffusion curve, which is an inviolate law in marketing that talks about adoption rates in modern society of any product or service, including cryptocurrency, I think that because we're in the early stages of that normal curve, I think that's the reason why this is still right skewed, because there's profits to be had, guys. There's still profits to be had, and people are flooding the market. If you just go back to economics, I'm not suggesting I know the economic framework that underlies cryptocurrency at all, but in general, hopefully you guys can at least find some merit in this analogy. There are profits to be had, and people are entering the market, and they're consuming those profits, and this right skew is indicative of that. If we look at the weekly return, we find similar distribution, maybe not so tight, a bit more flat, but nonetheless similar. And then the monthly return is fascinating because here's where you start to see there's some serious right-tailed action going on here, right? There's a lot more positive return than there is negative. And if you're thinking from strategy, right, so a personal investing strategy, this is, again, only for me, at least this is some of my reflections, hold for the long term, right? I mean, I guess here's the merit behind the HODL meme, right? Hold, diamond hands. This is some evidence to indicate that there is rationale behind that. The longer you hold, the more return there is, at least on this daily to monthly comparison. Let's see if there's anything interesting here that I'd like to share with you guys. Let's go to page 2698. 2698. Here's something I found fascinating. So when are the returns highest and lowest across the week? Starting here. In the Internet Appendix, we also show the mean, standard deviation, and Sharpe ratios of the returns on different days of the week. In contrast to stocks, there is no pronounced Monday effect. However, the returns are lower on Saturdays. The average Sunday coin market return is 0.28%, with a Sharpe ratio of 0.05 compared with a 0.46% daily average with a Sharpe ratio of 0.08. The average Sunday Bitcoin is, I think that's a typo there, the average Sunday Bitcoin return is a 0.29% with a Sharpe ratio of 0.06 compared with 0.46% daily average and a Sharpe ratio of 0.08. The average Sunday Ethereum is 0.25%, and it just pushes forward. And at the very bottom of this paragraph here, it says, while the coin market and Bitcoin returns are somewhat lower on Sundays, the returns on Saturdays are consistently lower. And what can we derive from that? Well, don't sell on Saturday. Don't sell on Saturday. Because you're going to get a lower return. If you want to take advantage and optimize or maximize your return, it looks like there are some daily effects here that take place that are negative on Saturday, for whatever reason that may be. Let's push forward. Oh, I forgot to show you. If we take a look at this, right, this table documents the summary statistics of the coin market returns. And I wish you guys could see my highlighted piece rather than this. I'll just try to highlight it here. I'm not sure if I can. No, it won't let me. But basically, this talks about the different disasters and the different miracles that happen across about 10-year span of their data. And they define a disaster as a decrease in the total coin market capitalization of the cryptocurrency market, a decrease of -5%, -10%, -20%, -30%, right? So increasing severity as we go down. And then miracles, increase of 5, 10, 20, and 30% respectively, increasing in miracleness, I guess you could say, as we go down. And look at the counts. Look at the frequency. 250 here, 318 there. There's more 5% miracles, and there are 5% disasters. 107 here versus 85 there. There's more 10% miracles, and there are disasters. 26%, or excuse me, 20% miracles versus 14 -20% disasters. And then look at this. Complete disaster of -30% only happens 3 times. over the span of, I think it was 2011 through 2018, 2013 to 2018, versus 10 times, occurring about once per year, a 30% increase in coin market capitalization. So just going off this data, if the past tells us anything about the future, if you park your money in the cryptocurrency market, you will experience this at least once per year, according to the data. I'm not saying it will happen, I'm simply saying that it has happened. It's happened in the past. That's incredibly fascinating, and it's also pretty, I mean, if that doesn't make you feel optimistic, then I don't know what will. And that's really positive news. Now, granted, I know there's economic effects that are going to start leveling these things out, but I don't think that's going to happen anytime soon. I think that cryptocurrency market still has a lot of space to grow. In total, liquid assets, in other words, cash and cash equivalents in the world. So how much cash and cash equivalents and liquid assets does the world hold right now? If you just go on Google and ask this question, it gives you a number of 36 billion and some change. Current cryptocurrency market is at 1.4, basically $2 trillion. So we have another $34 trillion to go. Now, if you want to be harsh and you want to add in debit, let's take a look at debit, because there's a certain percentage of unbanked people in the world. And that's unfortunate, because we know about the correlates between being banked and things like health and outcomes. Nonetheless, I believe it was something like 80% of the world's population has a debit card, something along those lines. So maybe it's not 36 trillion is the 100% maximum penetration cap or the ceiling for cryptocurrency, assuming it's 100% successful in penetrating the world's market as the leading transacting medium. Whatever $36 trillion times 0.8 is, that's a huge amount to grow, guys. So we have a long way to go before miracles happen at the same rate as disasters, right? So this equaling would most likely happen when we reach a saturation or a penetration that is near optimal. Let's push forward. Network factors. So the only thing I highlighted here is in this second paragraph, we construct network factors of cryptocurrency and test whether these factors can account for variations in cryptocurrency price. We use 4 measures to proxy for the network effect: number of wallet users, the number of active addresses, number of transaction count, and the number of payment count. Let me push forward here. Here it is. On page 2701, okay, so consistent with the prediction that cryptocurrency returns reflect expected future cryptocurrency adoptions, we find that coin market returns positively predict future cryptocurrency adoption growth as shown in Table 3. Specifically, coin market returns positively and statistically significantly predict cumulative wallet user growth at all time horizons, which is incredibly important. Coin market returns positively and statistically significantly predict cumulative price active address growth and cumulative payment count growth for the first 3 periods and 2 periods respectively. And they cease to be significant afterwards. So what does this mean? Well, very literally, it simply means that coin market returns positively and statistically significantly predict future cumulative wallet user growth. So if a specific cryptocurrency has high returns in the immediate past, let's say 12 months, then you can rest assured that research shows that there will be more user adoptions. And with a greater amount of user adoptions, that means more money flooding the market. So those folks are bringing their money into the market, which naturally means, assuming the protocol of the specific cryptocurrency lends itself to this, that the coin value will increase. And if you are holding that coin before this flood happens, this migration happens, then your wealth will increase with it. Let's push forward. Oh, here's another one. So on production factors. again, we would think that the price of a cryptocurrency is essentially the cost to produce the actual coin itself, and then maybe some profit built in, right? A profit that is proportional to maybe the amount of total users in the network, or some economic thing, what have you. But the research suggests that this isn't the case. So several papers have argued that the costs of mining are essential for the infrastructure and security of cryptocurrencies. Notably, Sakin and Jiang showed that in a general equilibrium model with cryptocurrency production, the prices of the cryptocurrency are intimately linked to the marginal cost of mining. But if we scroll all the way down, they come to the conclusion that, somewhat surprisingly, the coin market returns are not statistically significantly exposed to any of these production factor proxies. The R-squares of the regressions are low, right? And R-squares are just the explanatory power. What is the explanatory power of this model here? And this model is inclusive of all these production factors that they denote here. And it just so happens that there is nothing. There are, I mean, you don't, they would denote it with asterisks, right? So one asterisk is statistically significant at the 10% level, 2 asterisks means statistically significant at the 5% level, and 3 would mean at the 1% level, so more rigorous. And we do not see any asterisks here. We only see weak correlations. And weak would be, numbers that are close to 0, either negative or positive, it doesn't really matter. Like, for example, we see this relationship here is rather strong, but there are no asterisks alongside the figure, which means that the model itself is not statistically significant, or any one of those factors. Let's push forward. Okay. Let's go to page 2705. So, are cryptocurrency returns predictable? And we have a couple pages left. So in this section, we test whether the coin market returns are predictable. The existing theoretical models of cryptocurrencies provide various predictions on the predictability of cryptocurrency returns. Schilling and Uhlig from 2019 argue that the evolution of cryptocurrency prices should follow a martingale. Again, if you're just joining, martingale just means random, where the future price of any cryptocurrency has an equal probability of occurring well, let me reverse. Martingale just means in general, and forgive the simplification here, but martingale just means it's generally random, right? It doesn't matter. The price variations follow a stochastic process, and thus cryptocurrency returns are not predictable. Other papers predict that in dynamic cryptocurrency valuation models, cryptocurrency returns could potentially be predicted by momentum, investor attention, and cryptocurrency valuation ratios, and that's exactly what the authors of this article are partial to. Motivated by the existing theoretical development and empirical findings in the financial markets, we test whether the cryptocurrency returns are predictable by momentum, investor attention, and proxies for cryptocurrency valuation ratios. So, let's push forward to cryptocurrency momentum, and we'll tackle them one at a time. One of the most studied asset pricing regularities is momentum. As discussed in Kong, Lee, and Wang 2019, and a big thank you to them for being very important in this paper, the network effect of user adoption generates a positive externality that is not immediately incorporated into cryptocurrency prices. This channel can potentially lead to a momentum effect in cryptocurrency returns. In their model, Sakin and Jiang 2019 generate momentum in the cryptocurrency market through investor attention, a mechanism similar to DeLong et al. From 1990. In this section, we start by establishing that there is a strong evidence of time series momentum at various time horizons. And they specify time series momentum as compared to cross-sectional momentum, which you can look up. I don't have a particularly strong grasp on what cross-sectional momentum is, but from what I understand, it's basically comparing one cryptocurrency to another versus time series momentum, which is just comparing the price of a cryptocurrency now or some time period to itself some time period ago. Let's scroll down. So, the current coin market returns positively and statistically significantly predict cumulative future coin market returns at all 8 horizons. And what do they mean by 8 horizons? Well, they just looked at 1 week to 8 week horizons. So, if you're in it for the short or intermediate term, this has import in your life. And in particular, according to this research that we just read, if you want to make money in cryptocurrency, then you would have to find a cryptocurrency that has positive returns in the near past. And in this paper mentions like 12 months, maybe 6 months in the past. And then you would be able to then confidently say that there is a large probability, and we would reference these asterisks here. There's a large probability that the cryptocurrency price will increase over the next week, over the next 2 weeks, 3 weeks, 4 weeks, etc., all the way to 8 weeks. So that's what the research suggests. So then it would be wise then to hold the cryptocurrency for a month to 2 months, at least. Now this is me speculating here, but it would be wise to hold it to that point. Assuming you're going strictly off the literature, and this really goes against my nature, because as you guys know, I'm a value investor, and value investors, they like to hold much more long-term than that. This is incredibly short-term, but I'm trying to be flexible and open-minded about this, and we'll push forward. With that being said, let's see. Here's something fascinating. On page 2710, so 2710, negative investor attention. So what does negative investor attention do to the cryptocurrency price? The researchers have shown that unconditionally, investor attention positively predicts cryptocurrency returns. However, not all investor attention is positive. For example, in their model, Sakin and Zhang from 2019 differentiate positive investor attention and negative investor. Okay, here we go. The ratio negatively and significantly predicts 1 to 6 week ahead cumulative coin market returns. For example, a 1 standard deviation increase in the ratio leads to a 2% decrease in coin market returns in the next week. And of course, in this ratio, then, the numerator must hold negatively effective statements. Let's push forward. Consistent with the regression results, we find strong negative return predictability results of the negative investor attention measures. So they're bolstering or supporting Sakin and Zhang from 2019. Which is good to know, because again, if we're thinking from the perspective of an investor, if there's negative sentiment about a specific coin, and I'm thinking Bitcoin, and specifically I'm thinking about the amount of electricity that Bitcoin uses to steward its ledger, and if people like Bill Gates, who recently came out and said that he's concerned about Bitcoin because it's consuming an incredibly large amount of electricity to stay in existence, if more and more people start to say that, then you'll see, according to the research, the price of Bitcoin will start to decrease, or at the very least, be suppressed. Another way to see the results on the investor attention is that our measures of investor attention's proxy for speculative interest and sentiment in cryptocurrencies. Positive investor sentiment is followed by cryptocurrency price appreciation, and negative investor sentiment is followed by depreciation, which is good to know, because I mean, you'd like to think that the price would move accordingly, right? So if there is positive investor sentiment, like how CNBC came out with the idea, or the claim that Cardano, ADA, is a green coin, right? It's a leading green coin because it uses proof of stake protocol versus proof of work, like Bitcoin. So Bitcoin uses proof of work, which is incredibly electrically expensive, versus a proof of stake coin like Cardano, which uses voting and consensus, which is virtually electricity free to mine and steward its ledger. So CNBC comes out with that positive news saying that Cardano is the future green coin. Then, reasonably speaking, or logically speaking, we would want to see that that has a positive influence on the price or the value of Cardano. And we would also like to see that, not Bitcoin in specific, but just any general coin, we'd like to see that there's a rational behavior such that with negative attention, the coin value decreases, right? Because that would be rational. That would be what we expect. Let's push forward. There are some things that I'm skipping in the interest of time. 2713. Let's go to 2713. Okay, so cryptocurrency valuation ratios, going back to the idea of fundamental analysis and value investing. Are there some ratios that are readily available to us on places like CoinMarketCap where we could analyze the fundamental viability of any one particular coin? So they take a look at this. Additionally, they go on to say, we test whether the cryptocurrency valuation ratios similar to those in the financial markets can predict future coin market returns. In the equity market, the fundamental to market ratios are commonly referred to as valuation ratios and are measured as the ratio of the book value to the market value of equity or some other fundamental value to market value, like dividend to price or earnings to price, right? And this will show you the relationship between the fundamental happenings in the company. If you guys have followed me, then you know this intimately. Fundamental happenings of the company, like their earnings, right, their net income, as compared to their price, right? So you would want to see here, if you're a value investor, that the price is low and the earnings are high, then that means that that's an opportunity for you to gain money. Because naturally, and obviously, the market in that specific case is missing out on an opportunity, missing out on a really great stock because their earnings are massive, their price is low, that's a hit. And then that would be, this earnings to price ratio would be a huge figure, something like 60 or 120, whatever. But if the earnings to price ratio was low, let's say it was a fraction, like 0.5 or 0.75, then that means that the price is high and the earnings are, well, relatively low, and that means that it's overvalued. So you would want, in that instance, according to very basic fundamental value investing principles, you would want to split ways, divest from that asset because it's overvalued. And so you'd want to take your profits and leave. Much less literature on selling over buying, but I'm sure you guys understand the relationship here. Is there some relationship that we can find using this from the equities market so that we can try to make some sense of cryptocurrencies? Well, these guys try to get to that. Another value measure used in the literature that has been shown to correlate highly with fundamental to market value is the negative of the long-term cumulative past returns. And this is thanks to DuBont and Thaler from 85, 87, Fama and French from 96, and Moskowitz from 15. Thank you to those folks. It is more difficult to define a similar measure of fundamental value for cryptocurrency. You know, and here I get an expletive. No SHI, you know what. Incredibly hard. You know, this is a brand new technology, and I think that if anyone comes to you with any amount of certainty or confidence about their ability to fundamentally to understand the fundamentals underlying a cryptocurrency, I think there's a lot to unpack there, and I don't think even the experts have a complete grasp of the fundamentals. What makes a good cryptocurrency good? I don't think we're there yet. However, in their dynamic cryptocurrency asset pricing model, Kong, Lee, and Wang, 2019, argue that the cryptocurrency fundamental to value ratio can be defined as the number of user adoptions over market capitalization, which negatively predicts future cryptocurrency returns. And now that's a light bulb right there, because this reminds me a lot of this book here, because that's exactly how they suggest platform companies should be measured, right? Not in terms of their earnings or in terms of their balance sheet assets, because, you know, let's think, who's a platform company? Someone like Amazon, right? Are you going to measure Amazon's success on the basis of how much in assets they have? No, because why? They simply facilitate, you know, one of their main businesses, ignoring AWS. One of their main business, their main shtick is a middleman, right? They provide, they facilitate transactions between a consumer and a producer. So the producer is responsible for the vertical integration of their company, all the way from sourcing to packaging to then routing, sending it over to the Amazon facility, handling the customer service. I mean, from start to finish, they're responsible for that, right? And then Amazon simply facilitates the transaction such that if a consumer wants to purchase this product, then they go on Amazon, they find the listing, then the producer sends it to them via Amazon. Amazon takes their cut and then sends the rest to the producer. And there are some arguments in literature, right? And I learned this from this book, and then there's also another book that, if you guys have come this far with me, this is the book that I'm currently reading, The Business of Platforms, Strategy in the Age of Digital Competition by Cusimano, Gower, and Yaffe. They all say the same thing, that you measure an equity or a stock or a company that is doing a platform job, in other words, a middleman or facilitating transactions. You measure their success largely on the basis, if you're a value investor, on the basis of users playing in their market, right? So they always have at least two markets. They have the consumer or the producer, and those markets have to be balanced. So this is why when I saw this, I was like, this is a huge light bulb moment, because I think I'm starting to realize, and I think a lot of people are starting to realize, that the value of a cryptocurrency is not solely predicated on the basis of its technology. The underlying technology doesn't really matter, to an extent. So for instance, Bitcoin, people would look at Bitcoin and say, oh, it's a bubble, this is BS, it's not really worth $35, $45, $100,000. But I would say, hold on a minute. How many people are involved in this thing? And what is Bitcoin really doing? It's facilitating a transaction, a primal one indeed. It's a transaction of pure value, right? That can be used to pay for things. And it's doing a damn good job, a really good job, through a distributed network of nodes, of computers across the world. And it's very hard to hack it. Unlike Amazon, who is largely centralized, at least compared to cryptocurrencies. So this is where the value is derived from. People wonder, what's the value of cryptocurrency? Well, just ask somebody in Venezuela who can't rely on their dollar, on their peso, to transact. My wife was telling me that she saw people were putting barrels of their currency in the garbage, lighting it on fire, because it's useless. The incredible amounts of inflation has rendered it so. Same thing is probably happening in other countries, and I think that that's in part the reason why El Salvador has made the decision to adopt Bitcoin as its currency, because it's better than the alternative. It's better than the status quo for them. I'll get off my soapbox, but I'm sure you guys understand the reason why I was so happy to see this research article touch on some of these fundamentals, because it just intuitively makes sense. Where were we? Let's go to... This is a section that I'm going through the material, I completely highlighted this section to elaborate on. The market value of cryptocurrency is readily available. However, there is no direct measure of fundamental value for the cryptocurrencies. In its essence, value is a measure of the gap between the market value and the fundamental value of an asset. Because of the lack of a standard book value measure of the cryptocurrency market, we use an array of different proxies to capture the idea of fundamental value. We proxy the fundamental to market ratio by a number of value measures motivated by the finance literature. The first one is the long-term past performance measure, the negative of the past 100-week cumulative coin market return. The other four measures aim to proxy the cryptocurrency fundamental to market value directly. The user to market ratio, the address to market ratio, the transaction to market ratio, and the payment to market ratio, all good ideas. The idea of these four measures is to use some measures of the book value of the underlying cryptocurrency market and scale by the current market capitalization. The user base of the cryptocurrency market seems to capture the concept of book value in the financial markets. This is consistent with the theoretical literature of cryptocurrency of the cryptocurrency market that emphasizes the notion of the network effect, which can be proxied by the current user base of the cryptocurrencies. On the other hand, the market value of the cryptocurrency provides a market assessment of the current value of the complete cryptocurrency infrastructure. Therefore, the user base to market value measure can capture the notion of fundamental to market ratio in the financial markets. In panel A of table 12, we report the correlations across the different valuation ratios of the cryptocurrency market. The 5 measures are highly correlated with one another, as you would expect. I mean, they're very similar to one another, with correlations ranging from 0.73 to 0.91. The first principal component measure for the 5 fundamental market ratios has correlations of these here. With the long-term past returns, the wallet user to market ratio, active address to market ratio, transaction to market ratio, and the payment to market ratio, respectively. We regress the coin market returns on the lagged cryptocurrency fundamental to market ratio, and the results are reported. We document the regression results from 1 to 8 week time horizons. Although the coefficient estimates are consistently negative, none of the 5 standalone fundamental to market ratio predict future coin market returns significantly over any horizon. And that just makes me want to pull my hair out if I had it. I'm not touching my beard. If I had top hair, I'd pull it out here because, wouldn't it have been so nice if we could just do that? If we could just take a look at the wallet, the amount of wallets in the market, you divide that by the market capitalization, and you say, hey, here's an opportunity. Here's a cryptocurrency that's going to increase in value. Let's invest in that. But it's not the case. It's not the case. And that's okay. Because if it were that easy, then everybody would do it, and we would probably have no market. Probably wouldn't even be making this video. But anyways, we'll push forward. Let's talk about something interesting. So, exposures to other assets. Going back to the question of, is Bitcoin digital gold? Are cryptocurrencies a commodity? Are cryptocurrencies a store of value? Are cryptocurrencies like stocks? Let's take a look at that. So, both the cryptocurrency literature and the community have debated the nature of cryptocurrencies. For example, Schilling and Uhlig 2019 showed that in an endowment economy with both fiat money and cryptocurrency, the evolution of cryptocurrency prices is linked to that of the fiat money. Aleh et al. 2016 emphasizes the importance of the fiat money risk of cryptocurrencies. The cryptocurrency community has proposed that cryptocurrencies are digital gold and serve the purpose of the traditional precious metal commodity. Moreover, Schilling and Uhlig from 2019 argue that cryptocurrency returns can have exposure to macroeconomic risks such as monetary policies. In this section, we evaluate these claims by examining the relationship between cryptocurrency returns and traditional asset returns such as currency, commodity, and equity. So, in other words, are they related to one another? We'll find out. So, currency and commodity factor loadings. In an endowment economy, which we are in the United States, where fiat money and cryptocurrency coexist and compete with each other, Schilling and Uhlig from 2019 show that the evolution of cryptocurrency prices is correlated with that of fiat money prices. Aleh et al. From 2016 also emphasized the importance of fiat money risk of cryptocurrency. We test this prediction by investigating the cryptocurrency exposures to traditional currencies. Columns 1 to 6 of Table 13 show the coin market exposures to traditional currency returns. For currency returns, we consider 5 major currencies: the Australian dollar, the Canadian dollar, the euro, the Singaporean dollar, and the UK pound. The exposures of the coin market returns to these major currencies are not statistically significant, and the alpha estimates barely change. We further test cryptocurrency exposures on currency factors as in Lustig, Rusinov, and Verdeland from 2011 instead of the individual major currency returns. These columns show this. Consistent with the results on individual currency returns, we find that the coin market returns do not have significant exposures to the currency factors. We conclude that there is no consistent evidence of systematic currency exposures in cryptocurrencies. In other words, cryptocurrencies don't operate. They don't act like money. Another popular narrative around cryptocurrencies is that cryptocurrencies serve the same purpose as traditional precious metal commodities. In other words, is cryptocurrency digital gold? That is, cryptocurrencies are digital gold, quote unquote. If the investors of cryptocurrencies hold this belief, we would expect to find that the returns of cryptocurrencies co-move with the returns of traditional precious metal commodities. We test the precious metal commodity exposures of the coin market returns and report the results in Table 14. For precious metal commodities, we consider gold, platinum, and silver. Comprehensive. The exposures of the coin market return to these three major commodities are not statistically significant. Overall, we conclude that there is no consistent evidence of systematic precious metal commodity exposures in cryptocurrencies. So, is cryptocurrency money? Not really. It doesn't behave like money. Is cryptocurrency a commodity? In other words, does it act like gold, silver, or some other metal? It doesn't act like that. So what the hell is cryptocurrency, right? I mean, if we could find out what cryptocurrency acts like, then maybe we could help predict prices. In other words, if it acts like properties, and properties are down, and we're anticipating properties to go back up, then you would want to buy low and sell high. This is the reasoning behind trying to find the equivalent. Equity factor loadings. Here's something interesting. We document the common stock factor exposures of the coin market returns in the Internet appendix. For the equity risk factors, we choose the capital asset pricing model, Fama French 3-factor, Carhart 4-factor, Fama French 5-factor, Fama French 6-factor models. Again, you can appreciate these guys' comprehensiveness. The alphas for all these considered models are statistically significant, which is good. You want to see that. The average return of the period is 20.44%. Let me skip through some of this because I have the meat and potatoes highlighted for you guys. Here it is. 2718. So on page 2718, this suggests, so again, looking at equities and seeing are they similar to equities. This suggests that the coin market returns may co-move more with growth rather than with value firms. So there is some evidence to suggest that cryptocurrencies behave like certain equities, certain securities. The exposures to the RMW robust minus weak factor are positive and are estimated slightly more accurately than other statistically not significant factors. This suggests that the coin market returns co-move more with high profit rather than low profit firms. The point estimates on the momentum and CMA conservative minus aggressive factors are very inaccurate. Excuse me. So let's go back to, where is it? Here it is. This suggests that the coin market returns co-move with high profit rather than low profit firms. This fact reminds me of this book here. And why does it remind me of this book? It reminds me of this book because what is a high profit firm? A high profit firm is more likely to be a platform company. And a platform company like Apple or like Amazon have high profits because they're not involved in the assets that are being traded and sold or the services. They simply facilitate the transaction, which naturally, I mean, if you're just being the middleman, it naturally lends itself to an easy job. I mean, it's an easy job to be a middleman. And that's what these companies capitalize on. They make the transaction really easy. And it's not to take away anything from them. A lot of these companies are doing an excellent job of whatever it is they do, and that's why they're in the high positions that they're in terms of market capitalization. But they only get that high market capitalization because, and they've only gotten there in terms of Amazon and Apple because the fundamentals are just so solid. And what do I mean by that? I mean their income statements. They're producing a high amount of profit after all expenses are paid for. So I think that this is more indicative of the fact that cryptocurrencies are operating very similarly to these platform companies, which just so happen to have high profits. I could be wrong, but that's the first thing I thought of when I saw this. Again, it's simply anecdotal. I'd stick to the research if you're looking for hard evidence here, but that's what I thought of. Exploring the factor zoo, these guys then just go on to talk about how in finance there's all these other factors you can take a look at to try to explain the returns of any security. And they basically just go on to say that they only found four factors that were significant. Which, I mean, they don't even elaborate on what those were. They say go on their Internet appendix to find out. And I didn't do that. Macroeconomic factors. So we're down to the last couple pages here. We further examine the macroeconomic factor exposures of the coin market returns. For macroeconomic factors, we consider the non-durable consumption growth durable consumption growth, industrial production growth, and personal income growth, and see if any of those co-move with cryptocurrency returns. So, I mean, naturally, you would think that maybe as personal income grows, so do returns of cryptocurrencies, because with more money to spend, and you'd think that they would spend it in cryptocurrency, let's say. So just some back-of-the-napkin work there. But let's see what the research has to say. We document the results in the Internet Appendix. We find that coin market returns do not significantly load on these macroeconomic factors. Again, pulling my hair out here, because then what the hell does? It seems to be very limited. We further investigate the three major cryptocurrencies individually. For Bitcoin and Ripple, all the exposures are not statistically significant. For Ethereum, notably, the durable consumption growth factor has significant loading, which is fascinating because Ethereum operates more like a proof-of-stake coin, and in my opinion, the future of cryptocurrency is going to move away from proof of work because it is not green, and it'll move more towards proof of stake, which is less electrically intensive. So I know Ethereum is not fully there yet, they are transitioning, but the fact that as durable consumption increases, so does Ethereum, my only explanation for this would be that if people are buying more durable goods, then maybe they simply have more money to spend, and so those people are going to spend it on Ethereum. Maybe a spurious correlation here. Not too sure what to make of that. Let's see if there's anything else of value to provide. Let's see this, speculative interest. Here's something for you guys. So, speculative interest and sentiment. In this section, we test whether speculation and investor sentiment may be important drivers of cryptocurrency prices. We extract the speculative shares of cryptocurrency usage from Coindesk.com. And long story short, they find that the sentiment measure positively and significantly predicts future cryptocurrency returns, which is incredible. However, this result is distinct from the investor attention and cryptocurrency momentum results. All three variables are statistically significant in predicting future cryptocurrency returns in multivariate regressions. Fascinating. Let's see if there's anything else to share. This is not interesting. Let's go right to the conclusion. On page 2724. So what is the conclusion of all this literature? We find that cryptocurrency returns strongly respond to cryptocurrency network factors as suggested by the theoretical literature. However, our empirical results do not support the notion that the evolution of cryptocurrency prices is linked to cryptocurrency production factors. At the same time, the returns of cryptocurrency can be predicted by two factors specific to its markets: momentum, specifically time series momentum, as compared to cross-sectional, and investor attention. In contrast to the equity market, we show that the momentum results and the investor attention results are distinct phenomena, and there is only limited interaction between them. Moreover, cryptocurrency returns have low exposures to traditional asset classes such as currencies, commodities, and stocks, and to macroeconomic factors. So, the meat and potatoes of this entire article is, one, that time series momentum may provide insight into the future of cryptocurrency prices, and two, the sentiment, the overall sentiment as derived from tweets, at least specific to this research, can provide insight into the near future, and in this case, 1 to 8 week future time horizon when it comes to cryptocurrency prices. So then, some actionable things moving forward. If we were to act on something like this, then, if you were to, let's say, invest in a cryptocurrency, you would want to understand the concept of time series momentum more, and you would want to effectively calculate a time series momentum at the point in which you're interested in investing in any one cryptocurrency. And then number two, you would want to also understand the current sentiment about your coin. For example, I would hesitate to invest in a coin where the current sentiment is negative, because there's research or evidence to suggest that perhaps the future may be bleak for that coin, especially if you're playing the short game and looking to pull out. This article didn't really touch too much on the fundamental nature of cryptocurrencies, in the sense that is there some intrinsic value that we can derive, or that we can come up with for a cryptocurrency. I'm going to be on the lookout for something like that. But they did offer some back of the napkin stuff, like the amount of users proxied via wallets as compared to the market capitalization, which I found fascinating. However, that's not significant. That's some movement towards tools of fundamental analysis. One coin in particular that I find interesting is Cardano. And Cardano has a very strong white paper that talks about its mining protocol, Oribus. And Oribus is essentially what the cryptocurrency uses. It's a proof of stake coin that uses voting proportional to staked holdings on the network to mine its or to steward its ledger. So, when you take a look at something like that, how it's peer-reviewed, many universities are looking at it. The founder, Charles Hoskinson, and CEO, comes from the team that launched Ethereum. You take a look at the people involved, right? That's some strong indication that the coin may be a coin to contend with in the long term. And this is now going beyond this paper here, and it's going back to this book here, The Intelligent Investor. They touch on the power of management and how the future of any organization, firm, project, service, product, what have you, is intimately linked with the person or the people involved, the quality of the people involved. So, I guess we'll touch more on that at a later time. I'm going to reflect more on this paper and see how I'm going to package this tomorrow in tomorrow's interaction with you guys. But thank you for sticking through. If you've sat through this entire time, I highly suggest that you subscribe so you can continue to gain insight on how to analyze business performance and or cryptocurrency performance, so that your returns and our returns are increased favorably. I'll be seeing you guys in the next upload. Take care. Stay in touch. Let me know what you guys want researched next. I'm going to figure out a way to turn this off. But take care. Bye. Thank you for